Brian went over the background a little bit on the first two phases and went into detail on phase 3, which is the CARES Act. Also, the Main Street Act, which is part of the CARES Act, which was clarified last week. I've written articles on Family First, on CARES, and yesterday I finished an article on Main Street. So if anybody would like those, I'll give my email at the bottom and I can send it to you. I should issue my Main Street article tomorrow. But let's talk about beyond the loan programs for a minute and all the other relief that's available to you, which are corporations, partnerships, individuals, self-employed, Schedule Cs. What's available to you with respect to the CARES Act and relief in response to COVID-19. And let's just talk about the employee retention credit, which is pretty big. And so if you don't go in and take out a loan under the PPP program that Brian talked about, you can get a $5,000 maximum tax credit against your payroll taxes per employee. I'll go into a little bit of the detail of what's involved in that $5,000 number I threw out. It actually is 50% of qualified wages up to $10,000 between now and the end of the year. And I have an example in a couple slides. I'll show you how that works. But to be eligible for this retention credit, you had to be in trader business during calendar 2020, so in trader business before this all started when the act got passed. And you are affected by COVID-19. Let's just leave it at that. You either fully or partially suspended operations, or for at least one calendar quarter, your gross receipts dropped by 50%. So let's just go to who is not eligible for this employee retention credit. Those receiving the PPP loans. Okay, so if you get a PPP loan, you are not eligible for this credit. I've had people call me up and say, boy, I applied for a PPP loan, it never went through, I'm running out of money, what do I do? I said, well, then of course you're enacting, going after the employee retention credit, right? And the question was, what can I do? I said, well, if you got 100 employees, that's 100 times $5,000. That's $50,000 that'll help get you through. So with respect to, what are qualified wages with respect to that? And again, it's $5,000 max. So once you hit that for 2020, the rest of 2020, there's no more. Okay, so it's based on full-time FTEs. And if you have more than 100 full-time employees, that employee that you're calculating the $5,000 on, you're only eligible if the employee is unable to provide services due to one of those identified circumstances I just said on the prior slide, that you were affected by COVID-19. So that's if you have more than 100. If you have less than 100 full-time employees, most small businesses, every employee is eligible. So there's no limitation there if you're less than 100 employees. They're all eligible for the credit, whether they're able to provide services or not able to provide services. Again, I talked about the wage limitation is $10,000 per employee for the rest of this year. There are stopgaps in place for double counting or double benefits, the WOTC credit, the Work Opportunity Tax Credit that's been in the code for many, many years, and the Family Paid and Medical Leave Act credits that are also available, the second wave of COVID-19 relief that we talked about earlier. So let's just talk about let's say you apply for it and you apply on your quarterly Form 941. Those of you that deal with payroll know what a 941 is. It's your quarterly employment tax return. And that's where you pay your FICA, your withholding for your employees. Well, this is how you get the credit. So eligible employees will report the qualified wages and take the credit on that form, on your Form 941. Let's say that you max out on Form 940, the current second calendar quarter of the year. You put your credit on there, you have too much. You have more credit than that you max out on the form. You get all your money. New form. It's Form 7200. You're looking at it right here. And you can actually get a refund now of any excess amounts that you're due on this form. So there's a mechanism for getting the money to you. Let's just go through a real simple example. Company less than 100 employees. You've got Mary here, who in the quarter is, her wages are $7,500. So she makes $30,000 a year. You add her medical benefits of $1,500, as you can see on the example for the quarter, and she has earned $9,000 in the second calendar quarter of the year. You take 50% of that, and the credit you can take on your Form 941 is $4,500. Now that has not yet hit the limit of $5,000 that we talked about. So the remaining $500, as you see at the bottom, I say maximum credit of $500, that'll be available in the third calendar quarter. So assuming that Mary has the requisite small amount of wages in the third quarter, you'll pick up the additional $500. That's the employee retention credit. There is another credit, and there's just one slide on this, the employer payroll tax credits. This is a deferral mechanism. In addition to the credit, which is permanent, this is deferral. You can defer the 6.2% employee portion of your Social Security tax until half of it until the end of 2021 and half of it until the end of 2022. So that's pretty far out there. This does not apply if you've had forgiveness under the PPP program that Brian talked about earlier, so that's not available. This is only available if you did not get forgiveness under the PPP program. Again, this is deferral, not an actual credit. Let's just talk about real briefly, I'm looking at my clock here, make sure we have enough time, but what I think and what I've been telling people is one of the biggest opportunities and one of the biggest benefits for individuals and corporations in this tax act, and that's the net operating loss carryback provisions. You're not hearing a lot of discussion about this just yet. Why? Because we haven't filed our 2020 tax returns yet. They won't be filed until early 2021. But people are now starting to file carryback claims for 2018 and 2019. So let me tell you about this and where it's going to go and why it's going to be so big. The government, as part of the CARES Act, has eliminated several restrictions on net operating loss carrybacks. Prior to the Tax Jobs and Cuts Act, which was enacted in December of 2017, so effective for 2018 and 2019, we were no longer able to carry back net operating losses for either individuals or corporations. You could only carry them forward as a part of that tax act. Now, as part of the CARES Act, that's eliminated. And in fact, we can carry back losses from 2018 or 2019, so pre-CARES COVID-19 pandemic, or 2020, which you know how many corporations are going to have losses in 2020, huge losses. And you're going to be able to carry back those 5 years and recover the taxes that you've previously paid over the last 5 years. So companies just now and individuals are starting to carry back 2018 and 2019 losses. They're filing quick carryback. So for a C corporation, that's a Form 1139, and for an individual, it's a Form 1045. And the government will get you your money within 45 to 60 days after you file that form on a carryback claim. You don't need to file an amended tax return. Those are quickie claims. They've been out there for the 30-some years that I've been practicing. I've done hundreds of those in my career. They're very quick. You're not audited. It just sails right through. Later on, of course, they reserve the right to audit the numbers. In addition, as part of the 2017 Tax Act, we put a 80% taxable income limit on the amount of NOL carrybacks that can offset income. That's been eliminated. So you can carry back all the losses from 2018, 2019, or 2020, 5 years with no limitation. Let's just talk about rates. If you'll recall, the Tax Cuts and Jobs Act reduced the corporate tax rate, the centerpiece of the legislation, from 35 to 21%. That means in pre-2018, you were paying taxes at a 35% federal tax rate. What are we paying today? We're paying 21% today in 2018, 19, and 20. So if you incur a loss today, this is losses that normally would have been producing a carry forward benefit at 21%. You're able to carry it back to 35% tax rate years and free up that income tax. That's an arbitrage. That's a benefit to you. You're recovering money that was previously paid at 35% with 21% net operating loss money. What other things can you do? And for individuals, of course, the tax rate only dropped from 39.6 to 37% under the Tax Act, but there's a little bit of rate arbitrage there for individuals as well. There's another loss provision that's been modified to the benefit of taxpayers. Starting in 2018, 2019, 2020, individuals, married couples were limited to a $500,000 limit on losses resulting from business that flow through to their personal tax returns. For a single individual is $250,000. I've only seen this situation once where I have had an individual incur a $3-4 million loss through a partnership. We were only able to deduct $500,000 on that loss in 2019. In this, based on the CARES Act, there's no limitation anymore. That limitation is gone, and that individual now can claim the $2 or $3 million loss, not limited to $500,000. By the way, any excess over $500,000, that person was able to carry forward indefinitely as an NOL, but now it frees up that loss to be carried back. $2 or $3 million can be carried back, recover prior taxes that had been paid on a quickie carryback. So that's why that one's a big one. Interest deduction limitations. Guess what's going to happen? People are borrowing. So there's going to be a lot more interest expense out there in 2020 for both individuals and corporations and partnerships and all sorts of business entities. Everybody's going to be borrowing more. What happened in starting in 2018, there was a limitation on the amount of interest expense that you can deduct. That was 30% of adjusted taxable income. That has been increased to 50% under the CARES Act. So businesses can deduct more interest now than they could before based on the CARES Act. If that increases the net operating loss, that loss also can be carried back 5 years. Again, more benefit, more cash taxes being refunded to businesses and individuals. That's the interest limitation. AMT credit, this probably won't apply to many, but the Tax Cuts and Jobs Act eliminated the alternative minimum tax for corporations. And if corporations had a credit carry forward, you were allowed to take it over the next 4 years. So 25% of the benefit, if you had a $100,000 credit carry forward, you could take $25,000 a year. This CARES Act allows you to refund the whole thing in 2018 or take it over 2018 or 2019. So again, accelerating a deferred tax credit that's been out there that people can get access right away. Second, and part of what I think is most important on the net operating loss provisions is qualified improvement property. There was a glitch in the Tax Cuts and Jobs Act. And what that was any qualified improvement property, which I'll go over in a second, what that is, but that was depreciable property that previously was 15 years or less, improvements to your business, and that was being depreciated over 39 years. That was an error. And because it was being depreciated in 39 errors in the tax law, that it did not qualify for immediate expensing, bonus depreciation expensing. The CARES Act corrected that in a technical correction to the 1987 Tax Act, and it now qualifies any qualified improvement property as immediately expensable. So if you spent $1 million, $2 million on facilities that previously had been capitalized over 39 years and depreciated, you can now fully expense it in 2018 and 2019 when you elected to do that. And there are several ways to do it: amending a tax return, changing a method of accounting, and you can go back and now carry back that huge expense back 5 years as part of an NOL. What is it? Again, people ask me, well, it's a term, people use QIP, what is it? On this slide, I talk about it's improvements a taxpayer makes to interior portion of existing building that is non-residential, so a business building, including installation, replacement of drywall, ceilings, interior doors, fire protection, mechanical, electrical, plumbing, et cetera, et cetera. All of that is what we're talking about here, can be immediately expensed. And if you had those improvements in 2018 and 2019, go back and expense them now and carry back the expense if you run into an NOL situation back 5 years and get your money back. Small changes to charitable contributions and limitations for corporations was increased from 10 to 25%. I won't spend much time on the rebate. A couple of my sons have gotten the rebates this week, one $1,200 and one prorated because he made a little bit more than 75 grand last year. My son that works for Google. I think he got $675 back out of his $1,200. I think he makes $80,000 or whatever for this. You've heard of Google. And so they've gotten it this week. So that's great. If you're married filing jointly, it starts phasing out at $150,000 and totally phases out at $198,000. There's been a lot of discussion in the papers for people that didn't file tax returns past. How do you do it? Social Security beneficiaries, etc. The IRS has done a good job of setting up a website where you can track it, and if you haven't filed a tax return, you can enter your information now on the IRS website to make yourself eligible for the $1,200,000 credit. That's an advance credit. If people didn't get it, there'll be a new form on next year's tax returns, 2020 tax returns, that there'll be a true up on that and people can get it done too, but a little bit too late for them. Charitable contributions, there's an above line deduction. If you don't itemize, and 90% of the people after 2017 don't itemize, only 10% of people itemize now, you can take a $300 charitable deduction above the line, whether you itemize or not. So that opens up charitable deductions for everyone. And for those that do itemize, they're no longer subject to a limitation on adjusted gross income. You can give all of your adjusted gross income away. Previously, there was a 50% limitation on that. So if you had $100,000 of adjusted gross income, you can only deduct charitable contributions of up to $50,000. Now you can deduct all of it, all of your adjusted gross income. And then if you contribute even more, that can carry forward. Health savings accounts, all the due dates, by the way, have been extended to July 15th. Most states have followed that as well. There are a few exceptions. But now you can make your health savings account contributions through July 15th. And some permanent changes in the law that came about as far as CARES Act are concerned. Telehealth services are now covered without having to meet the annual deductible. The deductible in HSA is to be a high deductible plan. You no longer have to hit your deductible in order to do that. There are certain provisions for exclusion for student loans. They've been both suspended for 6 months and interest is waived for the next 6 months. And by the way, if your employer, as one of my sons had on one of the big 4 accounting firms, would contribute $5,250 up to his repayment of prior student loans, that's now tax-free to that student. Previously, if your employer gave you a bonus of $5,250 to help pay your student loans off as a fringe benefit, that was taxable income to you. Now that's tax-free. A little bit on retirement plan rules. I'll throw out a really aggressive strategy I've been thinking about. You can now, they've waived the early withdrawal penalties on your retirement plans. You can now take out $100,000 without an early withdrawal penalty in 2020. And you can include it, you would include it in income over the next 3 years, ratably over 3 years. Or if you decide to pay it back, things look rosier in 2021 or 2022, you can pay the money back over 3 years and not include it in taxable income. So no penalty, get this distributed over 3 years. But what if you take out the money this year and you have to be affected by COVID-19? That's the bottom of this slide. You're diagnosed with it, you have a family member diagnosed with it, or you have severe economic consequences. You take the money out, you qualify to do that, but you feel like the stock market is in a really low point right now, and it might be a buying opportunity a few months from now, and you're starting to recover. You could invest the money, play the market, and then still repay it within 3 years and not incur any taxable income. Interesting idea, very aggressive. I wouldn't do it. Retirement plan borrowing, also that's been increased up to $100,000, up from $50,000 previously. RMDs, required minimum distributions, if you inherited an IRA or you're over age 72, with some small exceptions, you don't have to take out a distribution this year. Unemployment insurance, Brian talked a little bit about that. I'm not going to go into it, but something I found interesting, short time compensation. This is not short-term compensation, not a typo, it's short time compensation. A little bit new to me when the CARES Act came out a month ago. Short time compensation where you reduce the hours of employees. Those still qualify for unemployment compensation. So again, it's a benefit for those. You've reduced the hours. Instead of laying off half your workforce, you reduce the hours for the entire workforce by 50%. They now qualify for unemployment benefits. And One of my favorites, before I turn it over to Brian, is Code Section 139. This came in after 9/11, and it's qualified disaster relief, and it allows an employer to give money to benefit its employees, without including it in taxable income. But it has to be the result of a national declared disaster, which this was. So this is the first time since 2002 that this tax code section entered our code that has been deployed, and companies can give money to their individuals on a tax-free basis. In fact, it's something I was going to write an article on when I get a little bit more time. It becomes more relevant. It won't apply to many people, but it allows you to benefit your employees on a tax-free basis because of the disaster. And with that, I'm going to turn it over back to Brian.